let's get your assessment of this quarter. So far, as we've seen for most of the year, down about 3% for the quarter to date, and that's it on top of the losses which we saw in the third quarter. Just run us through your thoughts on why negative sentiment is still as bad as it is today.
Well, it's still a continuation of the same story we had seen since commencement of this year. In October, there was a slight uptick in the market, but I guess that was largely as a result of earnings releases by corporate Nigeria. A couple of banks, and that was very good result, and the market all reacted this time surprisingly anyways, which was good, and I think we saw about almost a 3% appreciation in the market in that month alone. But by November, the euphoria was over, and then we're back into the doldrums. And well, I think it's still the same, more or less the same factors that has been plaguing the market all through the year, from the crisis in Europe, the fiscal problems in US as well. And I think on the domestic front, the retail part or side of the market is not as buoyant as we would like it to be. What you see in this kind of situation is when there's a kind of depression globally, you want the retail guys to step in to up the game and probably provide some stability for the market. But more or less, retail is not being living up to expectations in this regard. And of course, towards the end of the year, you expect what I would say higher demand for money in terms of for transaction reasons. So I guess there'll be less impetus to invest during this period in the run up to the Christmas period and the New Year as well. So all of this put together I think has resulted in what we're seeing right now. And even in December, as we speak right now, market is down about 1.2% in this month alone.
Well, it's always difficult to call 1 or 2 weeks, and as the market shuts down, what are your thoughts for where we might close the year? The index is down about 20% year to date. Do you think it will be slightly lower or slightly higher than that?
Well, I think probably the way to go is just down, but of course it won't be aggravated from where we are right now, for a couple of reasons anyways. Like I said, demand for money at this stage, I think, is going to be much more on the transaction end. People want to spend money, holidays and vacations and stuff. Even though if people don't liquidate their investment in the stock market to finance these endeavors, but new money won't go into the market most definitely at this point in time.
Right, so perhaps some of those companies that have done very well. Okay, let's take a look at the fixed income side of things. And, well, obviously, the story for this year has been the higher interest rate environment. But talk us through the yield curve. It's a bit of a bumpy. It's not really inverted, especially for the longer dated instruments. For 3 years, for instance, we're seeing yields around 15%. For the 5-year, 14.3%. For the 10-year, 14.5%. And then for the 20-year, down to 13 again. Give us your thoughts on why we're seeing that bumpy yield curve.
Yeah, I think it's a combination of pressures. Well, what I would call probably alternate pressures at both ends of the curve. On the longer end, we see kind of high demand pressure, probably from the institutional guys, local institutionals like the PFA, who probably would favor long-term government securities over the shorter tenured ones. But on the short end, especially the 3-year bond, we've seen pressures coming in from probably CBN's OMO operations. Basically, what we've seen in that segment of the market is an uptrend in rates, discount rates being offered by the CBN, and as a result, the effective yield in the market is high, which kind of has probably spilled over into the 3-year instrument, causing kind of pressure on the yields, upward pressure on the yields at that end. So basically, I think it's a mix of both factors, kind of resulting in kind of shape we have for the yield curve at this moment. But we think if a correction is going to happen, it's going to be from the longer end of the curve, not from the shorter end. As we think probably there will be an uptick probably in yields on the 20-year instrument, as opposed to the yield on the 3-year instrument dropping lower.
It'll be interesting to see how the market reacts to the inflation numbers, which we're expecting this week. But let's move on to the budget. It's widely expected that the budget will be presented this week. We've already seen some information about what to expect from the medium-term expenditure strategy program that has been released by the government, and it's been also debated by the National Assembly. Give us your thoughts on the 2012 budget and the trends that we're seeing, more so from what we're hearing from the medium-term expenditure program.
Okay, I'll just focus on 3 areas of the budget based on what we have. Of course, it's just skeletal information we have right now. the benchmark price for crude oil being indicated in the budget is $70 a barrel. I think that's fair enough, more or less, given the fact that crude oil, Bonny Light has traded above $100 since February this year. So I think that's fair enough a price. And also, you have to take into consideration, I think last week, the Eurozone or the EU as a whole is planning to impose more sanctions on Iran, one of which is probably to sanction the Iranian oil export into the region. So this probably would help increase demand for Nigerian crude, even maybe over Saudi Arabia crude, because of the quality of both crude exports. So I think for 2012, it's fair enough a deal to say $70 a barrel is a good benchmark. The second issue basically would be the plan to scale down recurrent expenditure and simultaneously scale up capital expenditure. Well, in some quarters, it's been opined that the guidance given so far by the Minister of Finance is a bit too slow and probably not as expected, more or less. But I think one has to take into consideration the fact that to scale down recurrent, well, like she had mentioned earlier on, you would have to probably prune down the number of MDAs and, reduce the amount of workers on the payroll of the government at the federal level. This wouldn't be an easy task, which could even turn out to have like a political undertone at the end of the day. So I guess it's maybe reasonable to say 1.5% rise in the capex and simultaneously reducing the recurrent by the same amount over a 5-year period is somewhat reasonable given the climate in which you'll be operating. And lastly, I think if you look at the debts, they plan to scale down borrowings, especially domestic borrowings, down to about 500 billion in the next 2-3 years, I guess. Well, it looks good as well, but I think the key concern for me here is basically the plan to rebase the GDP. Of course, when the GDP is rebased, a lot of the leverage ratios for the country would improve, and I think the key thing is to watch out for the temptation for government not to take advantage of the leeway in terms of the borrowing limits, because that would expand, obviously. And given government's recent expansionary fiscal stance, there's always going to be that temptation to take advantage of the leeway that will be created as a result of the rebasement of the GDP. So I think, well, for 2012, pretty much it looks like a good proposal, but going forward, with regards especially to the debt, national debt of the country, I think we would have to see whether government will be able to maintain its ground in terms of fiscal discipline.